Okay, so I'm going to share my screen. Today we're going to talk about tax smart giving. This is a topic I feel very passionate about because I love mission-driven work and the work that nonprofits do. And I also love charitable people who enable all those nonprofits' mission. And when you're able to figure out how to give in a tax-efficient way, instead of giving your money to the federal government, you get to give it to your favorite nonprofit. Who doesn't love that? So I feel very excited to be sharing this information with you. I've had lots of practice. It's a complex topic, but I've had lots of practice explaining it in the clearest language possible. I'm going to take you back to the beginning on it. Please feel free to ask questions along the way because sometimes something you don't get pops up again 3 slides, and if you didn't get it in the first slide, I've lost you. So Donna, you're going to help me manage that because I'm going to be focusing in on my slides. You just chime in. You can put your questions in the chat or put your questions in the chat. I think that's the cleanest way to do it. And then Donna, you let me know when someone has a question. Okay, here we are. So you may have heard that there is a big tax law that was passed in 2025. That's what we're going to talk about today because it changes a lot, especially about a lot of things, but especially about the tax deductibility of your charitable gifts. So today's presentation is tax smart guidance for you when you give charitably. I just want to restate a few things that Donna already covered. I am a nonprofit fundraising expert. I am not a tax advisor or a financial professional, although I have consulted deeply with all of those professionals in order to make sure the information I'm conveying to you is correct. I consider myself a generosity guide, providing you with enough information to make tax smart decisions that you can talk about with your tax advisor or with your financial advisor. I'm going to give you enough so that you can ask smart questions and get the answers that you want if you feel like you need extra assistance. I am CFRE accredited. You wouldn't know it. You know CPA, that's accredited for accountants. This is my accreditation for my fundraising expertise. I am, in full disclosure, an advisor to Charter Oak Cultural Center. I was at the Charter Oak Cultural Center last week and had the joy of getting a very thorough tour of your 2 buildings. I'm here based in San Francisco, but I am from the East Coast, and obviously I have very, very deep ties to the region, and I'm a donor too to Charter Oak. Who doesn't love getting that letter in the mail from Donna? There is nothing like it. I'm sure your boxes are filled with letters asking you to support their organizations. They don't write those letters like Donna does, and it really lifts me at this time of year. I think that letter's coming out real soon, so be on the lookout. So why are we talking about the new tax law today? Because this tax law will involve changes to the tax deductibility of your charitable giving next year, starting in 2026. You may take action this year on several things before 2026, but all of the things that are going on that we're talking about today are 2026. There's some strategies with getting ahead of it a little bit, which I'll talk about. So what you're going to learn in this session, 3 things. 1, there's a lot of terminology, and taxes are confusing. I'm going to explain how your federal taxes work, like really simply, because that's not so obvious, believe it or not. And along the way, you're going to wind up tripping up. If you ever see an article in a newspaper on social media, you're going to see terms like DAFs, QCDs, RMDs, SALT. I want you to know what these terms mean so that when you come across other articles, first of all, to follow what I'm going to tell you today, but Also, when you come across other articles, you'll have a comfort level with this information and it will enable you to get even smarter over time. Second, I'm going to give you a concise overview of the 2025 changes that may impact your giving. And then I'm going to give you some practical steps to maximize your tax benefits while supporting your favorite causes. And remember here, honestly, with a lot of this stuff, it's either give the money to the federal government or give it to your favorite nonprofit. You decide. I love that dichotomy because it's real clear to me. All right, so let's start from the basics. How do federal taxes work? When I researched this, I realized that this is actually not very obvious at all. So it's worth spending a moment to talk about it for a second. You take your income, you subtract your deductions. That gives you your taxable income, and depending on what your tax rate is, it's multiplied by the taxable income, and that's what you pay to the federal government. Now, you have two options as a taxpayer. You can take the standard deduction, which is a predetermined lump sum by the IRS, or you can itemize your deductions, whichever is of greater benefit to you. And I will get into how much the standard deduction is versus the alternative, but I just want you to know every year you have to figure out, am I in the standard deduction camp? Am I going to just take the lump sum? Or am I going to pull together all of my receipts and evidence of all these different, mortgage payments and state taxes and charitable giving and itemize all that and deal with that with your taxes? You may not realize this, but charitable gifts do reduce taxable income, but only if you're itemizing. How many people actually realize that if you take the standard deduction these days, you don't get a deduction for your charitable gifts because you're basically saying, I'd rather take the larger standard deduction than itemize all of my receipts, which may include my charitable gifts. Now, many donors default to the standard deduction because it's a large sum of money. But there are opportunities to itemize in the new tax law, and that's a good thing if you're a charitable person. So we're going to talk about that. So let's get into kind of one level deeper into this information. What are we talking about in terms of a lump sum? The standard deduction for single people is $15,750, and for joint filings, it's $31,500. That's a really big standard deduction. Back in 2017, Trump raised the standard deduction up a lot to this level, and it was supposed to expire this year. With this new tax law, this is now permanent, and it's the law of the land, and unless a new tax law overturns it, this is what our standard deduction is going to look like. It also moves a lot. Back in 2017, when the standard deduction number went way high, many people who used to itemize stopped doing so because they got more money back by taking the standard deduction than by itemizing. Now, if you're itemizing, that means that you are submitting your receipts for eligible deductions like charitable gifts, of course, mortgage interest payments, maybe medical expenses, and some state and local taxes. And depending on which number is bigger, the standard deduction number or the total amount that you're itemizing, that's the path you're going to go on. And you wind up choosing the higher of the two. And each year it could be different depending on your individual situation. Okay, so here's another term to get familiar with. Right now, I'm just kind of walking you through some terms, not so much strategy here. SALT stands for state and local taxes. SALT. Maybe you remember once upon a time, because you are all sitting in high tax states like I am, that you could take your local property taxes or your state taxes and submit them to your accountant, and that was a big deduction because you paid a lot in those taxes. Back in 2017, Trump raised the standard deduction to that $15,750 for single filers, and then he blunted how much you could deduct from your state and local taxes, capped it at $10,000. Made a lot of people in high tax states really mad. because that was one of the biggest deductions that they used to be able to take. The new law, because so many people in Congress were complaining from those high tax states and they refused to sign the law unless this changed, the new law expands how much you can take in state and local taxes as a deduction up to $40,000 as a household if you make under $500,000 collectively. This will expire at the end of the decade, but for now, if your state and local taxes are $40,000, guess what? That is actually more than the lump sum, if you're married, of $31,500. So now there are a lot more people who are going to be itemizing, and that might be you. Yes, Donna.
Sari, what is AGI?
Great question. It's adjusted gross income. So if you are filing as a married couple, it's the income of both people filing together. Okay, great question. Okay, another key term for you to get really familiar with, especially today. A donor advised fund is a charitable giving account that any individual can easily open. What is the purpose of it? It is a designated fund that when you put money into it must go to eligible nonprofits, and you cannot claw it back. You cannot claw it back, but it means that because the funds are definitely going to a nonprofit one day, you get your tax deduction the year you give the money to the DAF, and not when you move the money from the DAF into the hands of the nonprofits you are supporting. I'm going to say that one more time because it's a really important thing to have in your head. You get the tax deduction the year you move the money into the DAF, not the year in which you distribute the funds from the DAF to nonprofits. So right now, if you are making a donation through a donation transaction page on your favorite nonprofit like Charter Oak, you're using your credit card. That's not coming from a DAF, that's coming from your checking account. And when you make that donation, it counts for that tax year. The DAF allows you to impact the timing of your tax deduction, and it also gives you loads of control as to, you can take 10 years to distribute the money. More than that, you can distribute in 1 year. It gives you a lot of control. So these funds that are sitting in a DAF can be distributed over time to your favorite nonprofits, multiple years even, and it's really easy to use, and it makes things a lot easier at tax time. One, the IRS only needs to see the receipt that gives you evidence that you've moved the money into the donor advised fund. That's your tax break. They don't need to see all the receipts from every single nonprofit that you're donating to anymore. They just want that one receipt. So the paperwork is a lot easier. When you open up a DAF, it's collecting your donation history, so you can also much more strategically see who you've been giving to, how much you give to them in the last couple of years, and when was the last time you gave to them. For me, that is really hard to keep track of year to year. I kind of get a little a bit of amnesia. How much did I give to them last year? When did I give to them last year? I think I did. When you use a DAF, it's all sitting there for you. And I find that it's a really great strategic tool to use to manage my giving as strategically as I manage my retirement fund. And if you take charitable giving seriously, which you're all here, you all do, it's a wonderful tool. And it's really quite easy to open up. Okay, so that's what a donor advised fund is. Let's talk about a little bit more terminology. IRAs, RMDs, QCDs. IRA is an individual retirement account. For the sake of this conversation today, I'm talking about a traditional IRA. An RMD is a required minimum distribution. If you're nowhere close to age 73, you may never have crossed paths with this term, but it is a very important term to keep in mind. When you, if you have an IRA, when you hit the age of 73, the federal government forces you to take out a certain amount every year, even if you don't need the funds to live on. Why do they force you to take this out every year? Because they want to tax you. They want the taxable income then. So once you hit 73, you have to start receiving checks from your IRA. Now, many people have an IRA because starting at age, when you're retired, you may not have other income, and this is the income you're living on. Perfectly reasonable. But many other people might have other forms of income, vet benefits, maybe they own a rental property, maybe they're still working, all kinds of things. And maybe they don't need the money. But guess what? You have to withdraw it anyway each year, and you're taxed as ordinary income. So it's not great when that type of situation happens. Okay, qualified charitable distribution, QCD. This is a privilege you have starting at age 70 and a half. You don't have to wait till you're 73. It is a withdrawal from your IRA, which is fully tax deductible and can go towards your favorite nonprofits. If you're 73, a QCD can count towards your RMD requirement. Unless you send your RMD to your favorite charities, it is usually going to be taxed as income. It is going to be taxed as income, and it will even be taxed as income if your children inherit your IRAs. The federal government wants that taxable income. Now, if you have an IRA, depending on how you funded it, the limit, the ceiling for how much money you can make as a qualified charitable distribution is $108,000 per year per person. So that's $216,000 a year per couple, available, fully tax deductible for charitable giving. Again, if you need these funds to live off of, absolutely fine. You should be using, that's what an IRA is for. But if you have funds sitting in your IRA, this is the smartest way, and you qualify, you're age 70 and a half, this is the smartest way to make any kind of charitable distribution. And the hardest thing about it is picking up the phone and calling your financial advisor and learning how to do it. Because once you do it, you're in it, and it's easy. Okay. So before I get into the bad news about the 2025 tax law, I'm going to feed you some really great news. I told you before that you're either in the standard deduction camp or you're in the itemized camp in terms of a taxpayer. And that when you take the standard deduction, you're not eligible to submit any charitable receipts to the IRS because you've chosen the lump sum instead. However, starting next year, if you take the standard deduction, you will also be able to take up to $1,000 single or $2,000 married that you give in charitable gifts. You can take that as a deduction without itemizing. There's going to be a special box on your tax form for that, for people taking the standard deduction. This is fantastic, right? If you know that you always take the standard deduction, this is going to be a new, easy way to get a tax deduction for giving charitably. So you should definitely save that receipt. And that's pretty fantastic. That starts January 1st. That was actually something that the Association for Fundraising Professionals has been advocating for about 10 years. So it makes everybody, it rewards everybody for giving charitably. It kind of equalizes it. Okay, this is the last confusing thing I'm going to talk about, and then we're going to be in smooth sailing. But now you know all these acronyms right now, so you're going to be able to digest this slide. So, as I mentioned to you before, with the new tax law, the SALT cap, state and local taxes cap, raised to $40,000 for adjusted gross income. This is kind of a test to see if you can follow all this terminology. For those folks who are making $500,000 or less, it's standard. the standard deduction is permanent and it's inflation adjusted, so it's going to move up a little bit every year. So right now it's 31,500. It's probably going to be a little bit more in future years. So here's the example. If you earn less than $500,000, that means you're eligible to take up to $40,000 in state and local taxes as a deduction, and you are paying $40,000 in state and local taxes. $40,000 is greater than the standard deduction of $31,500. So that means you're itemizing. So what's happening here is that many more people, especially in high tax states like where you are, where I am, may now find itemizing worthwhile again. Okay, so I want to just recap a few things. If you've been taking the standard deduction, the lump sum, for a long time, you may again take the standard deduction next year, but this time you'll have either $1,000 or $2,000 to give charitably and get a brand new tax deduction for it. So save those receipts. Or you've been itemizing for a long time and that is your mode. You know you always have to itemize even regardless of all these changes. You're an itemizer. Then there are the folks in between where this change to the state and local taxes might tip you from being a standard deduction type of person into being an itemizing person. Okay, so I just kind of want you personally to visualize which one you think you are before I move into the next slide. Okay, so now here's the bad news. Here's where the federal government is, frankly, sticking it to nonprofits. But we're going to outsmart them in a second. Beginning in 2026, for itemizers only, the first 0.5% of your adjusted gross income is not going to be deductible for charitable gifts. That means that if your household earns $400,000, the first $2,000 you give charitably each year will no longer be tax deductible. That stinks. I just want that to kind of sit in here, right? But we can do something about this. Remember that conversation we had a few moments ago about donor advised funds? The solution around this is to take several years of your charitable giving, if you can, and bunch them into one big lump sum deposit into a donor advised fund. This has two effects. One, if you were taking the standard deduction, this big lump sum that you're putting in the donor advised fund might actually kick you into an itemizing situation, which is a good thing because then you get all that credit for being charitable. And then you can distribute the funds anytime you want. But it also, when you take multiple years of charitable giving and put it into your donor advised fund into 1 year, you will no longer be dinged that 0.5% every single year, only in the year when you've put the money into the donor advised fund and not when you distribute it. And I'm going to show you an example in a second that will make this super clear, but it will save you a ton of money going this route. Okay, so we've got two examples. The first, we're going to assume a household has $400,000 adjusted gross income, and they give $10,000 each year for 4 years charitably. Again, this could be it can be $2,000, it can be $600,000, whatever. But for this example, we're going to use a $400,000 household. And that means that their 0.5% floor that we talked about, the ding, equals $2,000 for them every year. So in the first example, this household gives $10,000 annually for 4 years directly to nonprofits. Then you move over to the next column. The first $2,000 is not tax deductible each and every year. Third column, they donate $10,000 for 4 years. They donated $40,000. However, because they made these donations each year, they're getting dinged $2,000, the 0.5% for them each year. So of the $40,000 that they've donated over 4 years, $8,000 of it is not going to be tax deductible. And $32,000 of it will be. Now let's go to the tax smart way. You take $40,000 in year one and put it into a DAF. Again, the first $2,000 is not tax deductible, but only in year one. You've donated a lump sum of $40,000 into your DAF in year one, and that first year, yep, the first $2,000 is not tax deductible, but not the 3 years after. And so your total tax liability is only $2,000. And instead of your $40,000 being taxed $8,000, that $40,000 is only being taxed $2,000, and you're getting a tax deduction on $38,000. That's a difference, scenario one and scenario two, of saving $6,000, which is a lot of money. And it's also a lot less paperwork, as I told you, at tax time. I think we have a question.
Yeah, we have a question from Lynn.
Sorry to interrupt. I just wanted to know, I was planning to use this strategy, but I wanted to know if the $2,000 ding is in effect for gifts made before December 31st of this year.
Oh my gosh, Lynn, you've asked the best question, because the next thing I was going to say is you all who are sitting in this session today are the smartest people in the room, because you're learning this before this goes into effect. So if you were to put the money in now for the next 4 years, there's no ding at all. That's my hot tax tip for you today. If you're going to do this, take action before January 1st. Is everybody following that? Great. Thanks, Lynn, for the question. Okay. So, first and foremost, whatever I'm going to tell you today, I want you to talk to your tax advisor, because everybody's situation is a little bit different. But these are going to give you some really smart questions to ask that tax advisor. So, I'm sure none of you are old enough to qualify, but if you were 70 and a half or older on this call, my suggestion to you is to talk to your financial advisor about giving from your IRA. It is the smartest tax move. Money coming as a qualified charitable distribution is not impacted by the 0.5% whatsoever. Whatsoever. It doesn't apply at all. It is fully tax deductible. It is very easy to do once you're all set up. I know that my financial advisor told me that when I'm ready to do this, he's going to give me a dedicated checkbook from that IRA. And then I just write checks from it. And that's how I give to my favorite charities. The money has to go directly to the nonprofits. And you can really unleash your generosity. Each person can give up to $108,000 per person in your household annually in this way. 100% tax deductible. It doesn't matter whether you're itemizing or taking the standard deduction. Does not matter. This is your privilege once you're 70 and a half. If you don't yet qualify for taking a qualified charitable distribution, talk to your financial advisor about opening a DAF. There are a lot of, I'm going to talk about this in a second, but a DAF is not limited to high net worth individuals, especially now with this new tax law. It makes sense for all kinds. If you're a generous person and take your charitable giving seriously, it makes sense to open up a DAF. You can find places to open up a DAF that are not expensive, have very low minimums, and it really is a wonderful tool to use to manage this part of your philanthropy. So opening a DAF and funding it is your next smartest tax move. If you have a DAF already, I recommend funding it before January 1st for the next few years so that you avoid the 0.5% floor. It's really easy to open, it's easy to use, and I have one. I just love it. Just as Lynn suggested, if your plan A right now, if you have the means now to fund it by December 31st, you should do it now because then you'll avoid this 0.5% floor altogether. But if you can't do that, if you don't have the funds at your disposal, my next recommendation is to bundle it and fund it in 2026 so that you can avoid this 0.5% floor in future charitable years. And if neither of the two apply, if you're not 70 and a half yet, and if you don't itemize, you take the standard deduction, then next year, make sure you are generous with organizations like Charter Oak and take that $1,000 or $2,000 charitable deduction. And you'd want in this situation to keep your donation receipts. You'll have to at least have record of them. So I've taken you through quite a bit of complex information. Hopefully it's far more clear and transparent to you how filing your taxes work, what the changes are with the tax laws, and what the strategies are to be as tax smart as possible with your charitable giving. I will tell you, though, that the hardest part in all this is changing your own behavior. Habits are very hard to break, and shifting your giving from a credit card or a check to giving from your assets, which is essentially what we're talking about, that's the shift to make. And once you've made the shift and you learn how to do it, it is quite easy to keep doing that. And in fact, I am so enamored with the ease of my own donor advised fund that I find filling out a donation transaction form for my credit card donations irritating because I don't have to do that anymore. It's all set up in your DAF. And once you've made the switch, the process is simple and powerful. And it actually feels really good to be like, I have a charitable giving strategy. Like I take my philanthropy, and we all are philanthropic here. I take my philanthropy very seriously because you know what? People like Donna Berman take your philanthropy very, very seriously. It's how she is able to accomplish the mission of Charter Oak Cultural Center. So it's a win-win for you, and it's a win-win for the nonprofits that you love. And giving tax smart simply makes your generosity go further. You all know that supporting a mission you care about is its own reward. So I'm hoping you might have some questions for me, but I am a fundraising expert. If you're affiliated with a nonprofit or you sit on a nonprofit board and want more insight on how to grow your revenue, that is what Donor Boom does. And this is how you can get in touch with me. And that is my presentation. Donna, what kinds of great questions do we have out there? Or did I explain everything so incredibly clearly that?
Did great.
Thank you.
It was really.
Did you follow me, Donna?
I absolutely did. Yeah,
okay,
it was really wonderful. And if I can follow it, anybody can follow it.
Yep.
Shawnee wrote that the Hartford Foundation for Public Giving can set up a DAF. And also Carly's here. She's from the Jewish Community Foundation, and they can help you set up a DAF very easily. And then Lynn raised an issue about, and maybe Carly, you can speak to this, not to put you on the spot, but is there a minimum donation? Was that your question, Lynn? A minimum donation that a DAF requires you to make to a nonprofit?
Is it okay if I jump in?
Yeah, jump.
Yeah.
Yeah, at the Jewish Community Foundation, the minimum is $10K for a DAF.
Oh, to even start a DAF.
Yeah.
To start a DAF.
It's just like opening up a bank account, though. Every institution is different. You are going to get a different service level working with Carly's organization, or maybe you prefer to work with your own brokerage firm. They might have a donor advised fund. That's how Schwab Charitable Trust, I bank with Schwab. That's how they work. Fidelity too. There are organizations like Daffy. They have a free option, and there's almost no minimum that you need to put in there to get it going. So you got to shop for it, right? Daffy is not going to be the Jewish Federation. You're going to have a different experience and a different service level, but there's a DAF out there for everyone. I like, this is one of the things that I really want to reinforce. We think that these things are for high net worth individuals only. Rich people only get to play with these great tools. No, this can be for everyone who gives charitably and takes that seriously.
Did anyone else have a question?
Yes. Oh, sorry, I didn't raise my hand.
It's okay.
I have a
Vicky
question.
Vicky has a question too.
Oh, I'll go after. That's
Okay,
fine.
Vicky, you want to go first?
Yeah. So my question is with the qualified, the QCD.
Yeah.
So I'm 73.
I was about to say, you're asking for a friend, right, Victoria?
So does that, if you do a QCD, does
Yeah.
that eliminate that it doesn't count as income?
Correct.
Correct. So
Correct.
you don't have to then do the whole thing with the itemization to get that.
Nope. Correct. I will tell you, Victoria, my mother is a very well-respected estate planning attorney in New York. And in August, I explained this all to her. This was my first, like, oh my gosh, this is profound. This is going to change a lot. And when I explained to her about the 0.5% not being tax deductible, but that a qualified charitable distribution is, she's almost 10 years older than you are, Victoria. She could have made this choice a long time ago, and she didn't. But now that when I explained to her that you're either going to be dinged that 0.5% or you should use your QCD, she goes, oh, I got to start using a QCD for my IRA for the very first time. Now ask yourself, why would a very intelligent woman who is an estate planning attorney for a living, who has been qualified for over 10 years to do this, not have done it for the past 10 years? Because it didn't matter before this tax law. This tax law imposes a big loss, a tax deduction loss. This 0.5% is a lot of money. Before, it's tax deductible. It didn't matter. Now it really matters. And so for the very first time this year, she is going to use her IRA to make her charitable gifts. So it really is a switch. I'm sure you've heard about donor advised funds before. They've kind of slowly and steadily become more important. The primary reason they started rising up in importance is because Trump in 2017 increased that standard deduction so much, and people wanted to use the DAF to itemize. They wanted to put that lump sum in just to be able to itemize so that they could get the full credit for their charitable giving, which was smart. But now there's a much more compelling reason to use a donor advised fund, because you're going to get the tax deduction you used to get. You're losing some of it. You're losing thousands of dollars every year unless you take a different action and change your behavior. So hopefully many, many, many more people are going to start to open up DAFs. And that's why there are many more options now. It's a much more developed industry. You have lots of choices.
So can I do a quick follow-up, which is, could I then take that RMD and put it in a DAF or?
I don't believe so. But you know what? This is where I say I'm a generosity guide. I'm not your tax advisor. This is a great question to ask your tax advisor. But I don't believe so.
Thank you.
Sure. Jenny, I wanted to give you a chance, and then Lynn, let's go to you.
Sure.
Hi,
Thanks,
Jenny.
Sari. This was great.
Yeah, good to see you.
No, I had no idea about any of it.
I know. Yeah.
First of all, this does not require a response, but it just infuriates me that they would make it harder for people to give charitably. To that, like, why anyone thought that was a good idea is just beyond me, to take away that first amount of money. But so that's just one comment.
Well, no, it deserves response. So
Okay,
first of all, thanks to the Association for Fundraising Professionals advocating for this,
Yeah,
the majority of Americans who do take the standard deduction now have a greater incentive to give charitably.
right.
So let's at least acknowledge that.
Yeah, that's
But
great.
the second comment is, why are they doing this? Because they want your money. They want to tax you. This is their way of raising taxes without raising taxes. That's
on
it.
the backs of nonprofit. Okay. All right.
Correct.
All right.
Yes, and generosity. That's right. That's the way.
Right. Okay. So my next question is, so with the DAF,
Yeah.
you're saying that it makes more sense to put money in a lump sum and then make decisions yearly about how much you're giving to different, and there's no limit, there's no time limit on when you, okay.
None. And that's actually a flaw from an,
Okay.
if you talk to a nonprofit
Yeah.
pro,
Yeah.
that's
Right.
a flaw in the DAF because people
Mhm.
get their fun. Let's say somebody sold a company. They might
Right.
park millions of dollars into a DAF, get their tax deduction, and then the nonprofits, it doesn't guarantee that the nonprofits see any of that money for decades.
Right. Right.
That's a flaw. But in this case, it's a benefit to you. And you won't do that, Jenny.
No, but it also means that you have to put in like an enormous or like yearly. I think, okay, how much do I have to give this year for, but I then have to think about putting in money this year for many years ahead, right? So I'm
I
trying
wouldn't
to,
even think about many years. Think about it
okay,
in terms of administrations.
okay.
Because
Oh,
tax
okay.
laws do change. They did change from 2017, right? Tax laws do change. And in a future administration or with a different Congress,
Yeah.
this might go away. So
Okay.
I think thinking about it from a 4-year standpoint, 3 or 4 year standpoint is a good thing. And I would also say that some is better than nothing,
Right.
right? So if you're able to put 2/3 of what you would give over 4 years in a DAF, you're still
Mhm.
saving, you're still getting that tax benefit.
Right, but you get the tax deduction for only the year that you put the money in, that you fund the DAF.
Yeah. So let's
Okay.
say,
Okay.
let's
Yeah.
just say,
Yeah.
you put, I'm going to use just
Yeah.
like round numbers here. You put in
Mhm.
$4,000 for the next 4 years of giving.
Mm-hmm. Mm-hmm.
But and you budget for yourself $1,000 for each of those years, let's say.
Mm-hmm. Mm-hmm.
Let's say you want to give more than that year.
Yeah.
Then you just pull out your credit card and let's say that's $250 that you want to donate. That $250 is just not tax deductible.
Right. Okay.
Instead of $1,250.
Okay. I get it. Yeah.
So some is better than nothing.
Right. Okay.
But Sari, can't you put more money in your DAF?
You can, but not everybody has thousands and thousands of dollars sitting around to prepay it for so many years. So I want to acknowledge that.
But over the years, you can, as the money diminishes, you can replenish it. You'll just have to get that 0.5% ding unless it's a different tax law.
And when you replenish it, you want to think about it as a lump sum of money. even if this ding goes away, we're still probably going to be left with this standard deduction versus itemizing situation. And a DAF, that's why it's been around for a little while. The DAF is still useful for that. It will still, if you put enough money into it, help you qualify to itemize. And then again, that's a tax break for you. So there are layers, and even if you actually don't get a tax deduction, it is so much easier to donate from a DAF if you're using an inexpensive one, particularly. It's just so much more organized, and it's fun to think about the fact that you've got this protected amount of money because you can't pull it out unless you give it. How am I going to spend it this year? Like that feels really good. It feels like much more intentional to me.
Yeah.
And, we're all losing our minds. So, like, I have no idea what I gave last year to my favorite charities. I can just look it up, and there it is.
Okay. Can I just ask one more maybe dumb question? Because when I hear the word fund, can that money grow in the DAF? Is
Oh,
that like
yes,
an invested thing? Like, so it's growing? Like, I want
it
to know.
is. Yes, I
Okay.
didn't want to
Okay.
throw that in there because that's
Oh,
like a whole other layer. But
but
yes,
that's
what
cool. Great.
happens is you don't get to invest it. The organization that is holding that money will invest it for you. And generally, if the market's doing well, you'll make some. And if the market is slow, you'll make less. But yes, it is growing. So that's the other benefit of putting in a lump sum of money.
Cool.
More money in there means more growth.
Great.
Yep.
Thank you. That's
And
great.
I'm
Thank
also
you.
going to say one other thing here, Jenny. Has anybody ever given stock as a donation or a mutual fund or a... Okay, we have a couple of videos off, so I don't know what heads are turning there.
Oh.
But you may have heard that giving stock is a very tax smart thing to do. Why is that historically been tax smart? Because let's say you bought a share of Amazon stock at $100 a long time ago when they just sold books, and today it's worth $1,000. If you were to sell that share, you'd have to pay capital gains tax on it, on the $900 that it grew. If you take that share of Amazon stock and you give it to Charter Oak, they get the $1,000 that you spent $100 to earn, and you avoid a capital gains tax on $900. So again, do you want to give it to the federal government or do you want to give it to your favorite charity? Those are that you don't get to keep it, right? Either way. So it's donating, and it's only helpful when you're donating appreciated stock that's grown in a lot of value. And you can talk to your financial advisor. You should say, what should I sell here that's appreciated the most? They can actually help point that out to you. And when I say stock, I mean any kind of security, mutual funds, ETFs, bonds, anything that's sitting in your brokerage account that can appreciate, that is in the same bucket that I'm talking about. Now, it is still somewhat tax smart to donate stock because you still save on that you still save on that not having to pay capital gains tax, and you still got to spend $100 for a $1,000 gift, but you'll be dinged the 0.5%. How do we avoid this? You move the appreciated stock into your donor advised fund. And the same bundling strategy that I mentioned applies. So you need to take one extra step, and then that's like a superstar of a tax smart way to give to a nonprofit. Because you get the appreciated stock, you spent much less money to give a bigger gift, and if you move it into a DAF, that helps you avoid the 0.5% floor.
That's cool.
That's cool, right?
Really
Not
cool.
bad for someone who's not a tax advisor. Lynn, you had a question a while back. I wanted to make sure we got to you.
I actually have three, but I know you may be very short on time. Let me rapid fire them.
It's
The
only 4:30 here, so I've got all kinds of
and
time.
Carly, my dad said I'm to meet you as soon as possible. I'm Bob Goldfarb's daughter. So hi. Um, anyway, nice to meet you.
Hey, Carly.
So the SALT deduction being raised from 10K to 40K, is that in effect for our 2025 return or our 2026 return?
Ask your tax advisor. If I had
Okay.
to guess, it's 2026.
Okay, that's
Oh, you
important.
know what? I'm not sure. Hang on. It might be this year.
Okay,
Ask
I'm
your
going to
tax
ask.
advisor. I am less sure about that answer.
Okay, because that may throw, I mean, I'm pretty sure I'm itemizing, but I just, anyway. And then the
Mhm.
next question is, I read online, and you may or may not know the answer to this, but I read not only are we going to have that ding that you've so well educated us about, but also if one happens to be in the top tax bracket, that
Yeah.
this year we would get 37% and next year 35%. Is that
Yeah.
correct?
Yes, correct. That is
So
a
we get
little bit more of the fine print that I don't cover in this, but yes,
another ding. It's a ding on
it
both.
is. It's
Okay.
right. It's raising your taxes without raising your taxes.
Okay, and this is probably my most important question. I don't know if it applies to anyone else here, but if you have a donor advised fund in one place and you may open one in another place
Mm-hmm.
later and can't do it as a fire drill today, like
Mm-hmm.
before January 1st,
Yep.
can one move part of one's donor advised fund from one organization to another, or once it's there, it's stuck
Oh,
there?
ask your financial advisor. I don't know. You can roll over an IRA. I don't know if you can do the same for a DAF. I would
Okay.
think maybe, you know.
I don't know because it becomes the property of that organization that is holding the funds. So,
I don't know if that's true. It's an irrevocable trust. So I don't know if whose property it is. I just know you can't take the money out
right, right,
unless it goes to a qualified charity.
right.
These are great questions for your financial advisor.
Thank you. I
Yep.
appreciate it so much. This
But
is a great.
think of this, like you can really ask some very smart questions now of your experts. Now that I've given you the language, the overview, a couple of strategies, I feel like a pharmaceutical commercial. You go into your doctor and you're like, I need this drug. I hear it's great.
Generally, if you give a contribution to a DAF, they do own it. And that's how you're getting your tax deduction because now it belongs to them. And you can still say, hey, I want you to distribute 250 to Donna, 250 to Sari, blah, blah, blah. But once you make that donation and you get your deduction, it's theirs.
Yeah, and I can't confirm or
Yeah.
deny that. That sounded super authoritative, Shawnee. Again, I mean, are you a CPA or a financial
No,
advisor?
I'm not.
Maybe.
I did open an account at Hartford Foundation.
Oh, great.
And
Okay.
it's pretty clear on the paperwork that once I said, hey, here's what I'm doing to open this, it's now ours.
Okay. That's what it
You
said.
can
Okay.
advise how you want it to go, or,
You
depending on,
do, yes, that
yeah.
is. Let's talk about that for just a quick second. So again, ask your financial advisor these really hard questions because this is actually more legal. Who owns the property, right? It doesn't, at the end of the day, it is not going to affect your strategy. It is irrevocable, but it may impact, Lynn, your ability to roll it over. I have no idea.
Yeah, I
But
was just curious if Carly knew, like, has anyone ever opened a fund at the
yeah,
Jewish
great
Community
question.
Foundation from the Hartford Foundation funds, for example?
So just to, err on the side of safety because we play lawyers on TV, I also like default to what Sari is saying, where, you definitely want to talk to your financial advisor. In my time, I have seen some inklings of um like distribution of taking money out and going to another foundation. And I've also seen people come from another foundation and come to us. It's kind of like, it's all the things that Sari was talking about that, um, like once you find your best fit, like it's like assume that you'll stay for a long time at whatever, entity you so choose, just so that, it's the ease and comfort that it's not like swapping around and playing like a credit card. It's like a very different way of thinking about your money over time. So, you know, it's not encouraged to like travel so frequently, and I'm trying to find the right words myself. So just so that people know here, when I work at the foundation, but I work in like legacy gifts. I work with a women's giving circle. So the person to really speak to at my foundation is a different person even than myself. But as Shawnee was saying, everyone's paperwork is also different too. So what Sari was saying about finding your best fit, your comfortability level of whatever documents you're signing off on, is the best fit that you should go with for your foundation of choice or your DAF of choice. Sari, did I answer that correctly?
Yeah, talk to your financial advisor. Carly
Yeah,
said
yeah.
the right thing. She said the right thing. And Shawnee, you raised a good point that I want to just piggyback off of Lynn's questions here. When you put the money into a donor advised fund, the transaction is not going to look like your bank account. You don't get a checkbook from a donor advised fund. What happens is that you fill out a request. I want to give Charter Oak Cultural Center $10,000. You put it in there. Does that sound like a good number, Donna? You just $10,000. You throw that in there. You click on a few buttons. I highly recommend you click on the buttons that allow the nonprofit to see who it's from, because you can actually do it anonymously. It's very problematic for nonprofits if you don't identify yourself. Why is that? Because what then happens is you're asking your institution, like Jewish Federation, to grant the organization of your choice on your behalf. So then Jewish Federation will then confirm that Charter Oak is a 501c3 in good standing. It is. And then they will send the check. And the check is from Jewish Federation. The paperwork, if you check those boxes, the paperwork will say this is coming from Carly Norman's donor advised fund. So when Donna receives a donor advised fund check, she's getting it from Jewish Federation on behalf of Carly Norman. That's how it works. It's a little bit different than a checkbook. So when you open one up, I don't want you to be like freaked out that, what do you mean I have to ask permission to move the money somewhere? That is how a donor advised, it's in the name, it's a donor advised fund. You get to advise the fund where you want the money to go.
I'd just like to add for newbies, because I'm still only a few years into it, that it's also important, and I haven't done this yet, to provide succession rules and successor advisors. Otherwise, the funds that you leave there would be just managed by the foundation itself later. So it does have to be planned for, just like the rest of your assets.
And Lynn, do you know, and again, this is probably a question for your financial advisor, but can you name a nonprofit as a beneficiary to the balance?
Yes, it would turn it into a designated fund, it's called.
Okay.
So it would change the administrative fees if it, like upon my passing, I made it could be a field of interest fund. It could be, which means like the arts, or it could be all of it goes to Charter Oak. That makes it a designated fund. So you have to know, and apparently the administrative fees vary. And the thing I put in the chat like half an hour ago was not a minimum amount to establish a fund, but just to be aware that there's usually a minimum amount that you can grant from your donor advised fund to the recipient organization. So Hartford Foundation wanted to make it easier to make grants. So a few years ago, they lowered that from $500 to $250. But you can't make a grant smaller than that from that organization. It's just an administrative issue.
Yeah. So again, ask your tax advisor, your financial expert, but I'm seeing in the chat that the SALT limit is going to increase, applies for this year. So you might be itemizing this year. If you took the standard deduction, you should talk to your accountant about that. There are lots of great places to open up a donor advised fund, the Hartford Foundation, the Jewish Federation, your brokerage account, very low cost options online called Daffy, that type of thing. There's a huge range out there. You want to do your research, and there are different pros and cons to going each way. Somebody just explained that, the minimums, lots of these organizations that are running DAFs have lowered the minimum amount that you can donate, which for me means every time I want to make a donation, when I get all these, envelopes, I just stack up the pile of envelopes on my desk. And then when I'm ready to make my donations, I just go into the donor advised fund, tappity tap tap, and just do it all there. Donna, any final closing wise words from you besides it feels great to give and you need to get off mute? There we go.
Yeah, there are all these studies. I mean, we're talking to the choir here. I know you've all been so generous and you're so kind, and I'm so glad you're here tonight, and I'm very grateful for all your support. But there've been all these studies about what the endorphins that get produced when you are generous. Like, it just feels really good in your body, and it's good for your body, and it's good for your soul. And so it's a different kind of sacredness than I was used to when I was in a congregation. But it is an aspect of the sacredness of the work, for example, of the Charter Cultural Center. I mean, with your generosity, you are helping us do the work that we do. And it's the same thing for all the other good causes that you want to support. So thank you for coming. Sari, thank you so much. I want to bat mitzvah you again. You were so so clear.
You'd have to bat mitzvah my Soviet twin, Maria, who I was bat mitzvahed with. Do you remember back in those days?
Yes.
We did us both.
Oh my God. I remember we had a chair for her, right? We had a chair for her.
Yes, we did.
That's right.
Times they've changed.
Thank you very, very much for this great presentation. Does anybody else have a final question before we go that you've been dying to ask and you just didn't have the opportunity?
Yeah, I mean, Carly, if you would like me to speak to any nonprofits that you work with, I give a talk for nonprofits a lot.
That's really good to know. I'm so glad to be connected with you, and it's so nice that we share this childhood knowing of Donna, because she was a part of my formative Jewish upbringing as well.
Brilliant.
So this was so wonderful. So we'll definitely speak offline for sure.
Sounds great. Happy holidays, everyone. Thank you so much for repairing the world. Really. Thank goodness for you. That's what I have to say. Donna, thanks